Now this time, number 5 in this series, we've gone through where to find the information, how to look at the profit and loss account, the cash flow of the balance sheet, gauge the importance of types of news flow, and now we're really getting into the nitty-gritty if things can affect price and also value. So again, short-term sentiment, long-term fundamentals. But before we go any further, all important disclaimer, please take time to study this. So on we go. Factors that can affect a company or move its share price, and there are differences, as we discussed in number 4 with that fantastic chart of ARM, but price is really sentiment. You can say trading or short-term, lots of different things, but generally fashion, fear, and greed can all play a massive role here. Voting, that Benjamin Graham quote about the market in the short term being a voting machine and in the long run a weighing machine. Factors that affect price drive votes. Factors that affect value, cash flow over time, they affect the fundamentals of the business, its ability to generate cash, reward you with dividends, and also the growth rate of the company, the risk associated with its strategy, the predictability of its cash flow. Those things really in the end drive value, and that comes from cash. Buffett, he looks for economic castles surrounded by unbreachable moats, strong competitive positions. We've talked a lot about the pumping, beating heart of a company, best measured by operating profit, which then filters through to the net profit that we own as shareholders. Where does that strength come from? What does a strong competitive business model have? Well, it has a big market share or a strong brand that makes people want to pay for the product, want to stump up for it because they want it. A technological edge, intellectual property, scale, again, market share, an installed base of revenues. There are very few better models than selling somebody a piece of kit and then sending a man or a woman around with a bag of spanners for the next 10 years to service it and make sure that it works. And actually, that's part of Halma's success. Repeat business, again, one of the reasons why we've picked out Halma as an example of this. Though again, that's not a piece of advice with regards to Halma as a stock to buy or to sell. But those are the things you're looking at when it comes to company strategy and how it can then turn that, hopefully, into decent operating margins and cash flow. So strategy really is about winning a customer. If you've no customers, you aren't going to create much profit or shareholder value, are you? Right. Happy, not just finding customers, but happy customers. And a happy customer is getting a service or a product that they want, and also they're prepared to pay you for the price for it. If you can charge a customer the price you're prepared to charge and they're willing to pay, you're in business. If you have to have a prayer meeting every time you try and put up your prices, you have a problem. And if the customer balks at your price, you have a problem. So you really need to provide them with a solution or gratification or somewhere between the two. And then as a company, you've got a sound strategy and a sound competitive proposition. The challenge then, of course, is does somebody else come in and try and copy it? But at least you've started off in the right direction. Competitive advantage, you measure that through operating profit and operating margin. Then over time, how do you transfer that? As a leader, it's really hard. Yes, you need good management, you need good governance, they need good advisors, but in the end, leaders change. Jim Collins always talks about level 5 leaders, not those who could do it when they were there, but who laid the foundations for an easy transition and the model kept on working. Do you want to know how hard it is? Alex Ferguson couldn't do it at Manchester United. I'm not a Man U fan, but what he did was amazing. But look how hard they found it since he's gone. That's how hard it is to be a level 5 leader. But ultimately, if you can do that with successful strategy, successful plans, successful future planning, profits, cash flow, and then for you, the shareholder, dividends. So how can you tell a strategy is working? Operationally, pricing power, market share, barriers to entry, happy stakeholders, happy staff. Financially, high profit margins, again, the operating margin, high returns on capital, strong cash flow, and ultimately happy shareholders because they're getting their slice of the action either through a rising share price or a rising dividend or both. So how can you judge a competitive position? Well, I haven't had to make this up. This is Michael Porter, his 5 Forces, Harvard Business Review in the 1970s. He's refined it since. This still works for me. Whenever I look at a company to write a column or a piece or I'm on the television, I'm trying to think about this all of the time. So first of all, in the middle, you have industrial rivalry. If you're making a lot of profit, some of the devil's going to turn it around the corner and try and get their slice of it because that's how capitalism works. What's the best cure for high prices? High prices, because it generates more supply and more competition, for example. So that's the first thing to look at. What's the dynamic with the industry? But then you have to look at how easy is it for me to deal with my suppliers? How easy is it for me to deal with buyers, new entrants, substitutes? All of these things will affect demand for my product, the price that my customers are prepared to pay in exchange for their solution and their gratification. Can they get the solution more cheaply and just as good somebody else? Great. Generally, I look for companies that do things better, not more cheaply. There'll always be a kamikaze merchant that can come in and undercut you, but they might be cutting corners someplace, and that might catch up with them in the end in terms of the quality of product or service. But again, that's something that only your research can help you judge. Again, strategy is not, we've discussed this before, strategy, and if a company says to me this in a meeting, I'm pretty much folding up my book and closing the door on them, except that'd be really rude, so I'll stretch it out for a little bit. But if a company says to me, our strategy is to grow, buy, our strategy is to make a profit, buy, our strategy is to create shareholder value, buy, book, snap, shut. You can't do any of those things without customers. So what I want to know from a company is how do they get the customer through the door, and how do they get them to pay for the product or solution that they're offering. The numbers, the profit, the growth, the shareholder value, that's how we keep score, and we looked at that in video 2 and to a degree in video 3. That shows how efficacious is the company's strategy and how strong is its sense of purpose. And companies will try and prove to you by making their forecasts that they're doing a really good job, but then you've got to be aware that they don't get a little bit creative with the numbers and start making them up. And just as a spectacular example of why growth is not a successful strategy or can be a very dangerous one, here's our good friend NatWest Group, used to be known as Royal Bank of Scotland. They may have changed the name for a reason given this share price chart. And in fairness, NatWest charts are now at an 11-year high, though you wouldn't guess it from that chart there. But yes, Sir Fred Goodwin acquired lots of businesses and grew the Royal Bank of Scotland. Didn't work out that well in the end, did it? So, when you're assessing a company's model, how do you break it down? We've already talked about price times volume minus cost equals profit. These are some of the things that will help you understand how those dynamics then fit together. I won't read out every single one, but there you've got demand, secular or cyclical, you've got pricing, and you've got costs. Drivers of volume, drivers of price, drivers of cost, and they will give you a really deep understanding of what really makes a business tick. And companies will help you. They will talk about what are their KPIs, their key performance indicators. It will vary from industry to industry, but nevertheless, once you get a strong feel for those, you'll get a strong feel for what really makes a company tick over the long term. Now, again, I can't read all of those out. I will bore you to tears. So pause the video, read them, soak them up, note them down, note them, but they're a really, really good, crisp guide to judging risk and reward. Whether it's looking at, again, the high operating margin, the pumping, beating heart, whether it's looking at free cash flow, return on capital, the amount of risk in the business posed by operational gearing, how much revenue, how much profits change for a 1% change in sales, and financial gearing, again, that debt calculation that we did that included pensions liabilities and contingent liabilities. Interest cover, free cash flow cover for dividends, for all of these things, very important. And again, not just for 1 year, definitely not for just 3 or 6 months, but over a period of time, and preferably over a full economic cycle to give you a good long-term picture of how a company performs, not just when things are going well, but when they're going badly, because inevitably they will, because of the cycle or product cycles or competition, how they respond to that, and then you get a real feel for reward and risk over a long period of time. So yes, narrative helps, narrative matters. It can carry a stock a long, long way, but ultimately maths matters, and the maths is operating margin, net profit, cash flow, and they in turn drive things like shareholder rewards and dividends. And then of course you've got to take into account valuation and making sure you don't overpay in enthusiasm for that particular narrative and that cash flow and that net profit and that operating profit. Growth? No. Stretch shareholder value? No. Profit? That helps, but they're not strategy. They're what results from the strategy. They measure the efficacy of strategy. And again, looking at organic growth, operating margin will help us really judge the strength of a company's business model. Firms that can show positive trends here, it's always a good sign. They will attract a premium valuation for predictability, consistency, and high returns. The P in the PE, the more dependable a business, the more profitable a business, the faster it grows to a degree, as long as it's organic, the higher price or multiple people will pay of that earnings. And if the earnings grow as well, you get a double whammy. Price up, multiple up, share price bang. But as we saw spectacularly with Royal Bank of Scotland, NatWest as it is now, that can go into reverse. Things go wrong, people get frightened, they pay a lower multiple, the earnings go south, double whammy works the other way down. So that's again how we try and measure what the risks are, not just rewards. So always think of P and E or multiple and E in the context of this 3D picture that we've built of profit and loss account, cash flow, balance sheet, and numbers, strategy, valuation. We're through 5 of the 6 videos now. Coming up to the last one, so we're trying to build this full picture, again, of numbers, strategy, valuation, and in the last one, we're going to pull it together with some practical, historic examples that won't be investment advice or recommendations, but hopefully will give you some useful pointers as to what to look for when you're doing your own research.